Real estate is a hot topic in Canada. From soaring home prices to short-term rentals, everyone seems to have an opinion. But what many are not informed about are the significant tax traps that lie hidden inside real estate. Hi, I'm Jillian Battaglio. I'm a chartered professional accountant and the founder of TaxWrx. For the past 10 plus years, I've worked extensively with small businesses, homeowners, and rental property operators as their tax advisor and accountant. Today, I want to highlight 3 super common real estate tax traps that you are probably going to want to know about. Number 1, the residential property flipping tax trap. Introduced in 2023, the residential property flipping rule now means that any properties held for less than 12 months are 100% taxable upon sale. This means the principal resident exemption and the 50% capital gains tax break aren't available unless certain life events such as the death in the family, breakdown in a relationship, or having to move for work required you to sell your property. Outside of these life events, you're going to want to ensure that you own your property for at least 365 days to take advantage of the principal residence exemption and capital gains tax break. Number 2, the side hustle tax trap. Are you using a portion of your home for producing income? Let's say you rent out your basement to a long-term tenant or turn your garage into a barber shop. You may end up owing capital gains taxes on the portion of your home when you sell. This is because the principal resident exemption is only available for personally used property, not income-producing property. If you are using your home for business or rental activities, the principal resident exemption may be disallowed on that portion. Now, some good news is that the CRA does allow a reasonably small portion of your home to be used for income-producing purposes without putting your principal residence exemption at risk. However, they don't define reasonably small, so we generally recommend being on the conservative side. Writing off large portions of your home may not be advantageous in the long run. Number 3, the change in use tax trap. Change in use tax traps are quite common, but relatively unknown. A change in use happens when you change all or part of your principal residence into a rental property or the other way around, going from a rental property or small business to a personal use space. Let's say you decide to take a sabbatical for a year and go traveling. Now, to help fund your expedition, you decide to rent your home while you are away. You've just had a change in use of your property from principal residence or personal use building to an income-producing asset. In other words, you've just made your property taxable. A change in use is important because it triggers a deemed disposition for tax purposes. Essentially, the CRA deems you to have sold your property to yourself at its fair market value. Any increases in value between the time you move out and when you return home are not covered under your principal resident exemption, unless you are eligible for a special election. Don't get caught in a snare. Real estate and rental property issues come with some pretty big tax traps. I've mentioned 3 super common ones, but there are even more that you are going to want to be aware of if you are a homeowner, small business owner, or rental property operator. The resources inside TaxWrx cover common tax issues and the solutions that I help my clients implement every year. Don't end up with an unexpected tax bill in the thousands of dollars. Find the information and tax resources that you need today. Check out TaxWrx.ca to learn more.